Frequently asked questions. The 1031 exchange identification rules. In this segment, we're going to review the ways that a taxpayer can identify property in a delayed exchange. And there really are three different rules that a taxpayer can take advantage of, three different ways to identify property. The first rule is what's known as the three property rule. Under the three property rule, a taxpayer can identify up to three properties of any fair market value. So they're unlimited on value, but there's a restriction on the number to three properties. So for example, a taxpayer can sell a property for $1 million and identify one replacement property at $1.4 million, a second replacement property at $2 million, and a third replacement property at $3 million. So under the three property rule, it's fairly straightforward. The taxpayer is limited to no more than three properties without regard to the fair market value. The next rule is what's known as the 200% rule. Under the 200% rule, the taxpayer can identify an unlimited number of properties, but the total fair market value of all properties identified cannot exceed 200% of the fair market value of the relinquished property. So this one's kind of the reverse of the three property rule. There's an unlimited number of properties, but there's a limitation on the value, no more than 200% of what was sold. So using a similar example, if a taxpayer sells for $1 million, they can identify as many properties as they want, but when you add up the value of those properties, it cannot exceed 200% of what was sold. So in that case, $2 million. That's the 200% rule. Finally, the last rule, and this is the one that's probably used not nearly as often as the other two rules, is what's known as the 95% rule. Under the 95% rule, a taxpayer can identify more than three properties and more in value than 200% of what was sold. So they have an unlimited number of properties and an unlimited number of value. However, the taxpayer must actually acquire 95% of the value of the properties identified. So this is called the 95% rule because that's the requirement of the rules, is to acquire at least 95%. Practically speaking, in most cases, it means the taxpayer, if they're using the 95% rule, they're going to need to acquire essentially everything that they've identified. So there's very little wiggle room or opportunity if there's a bad inspection or something that is not favorable to the property. You really have to acquire essentially everything identified to hit that 95% threshold. So let me just review quickly again. Three property rule. You've got an unlimited value, but you're limited to three properties. Under the 200% rule, an unlimited number of properties, but limited to no more than 200% of the fair market value of what was sold, the relinquished property. And then finally, under the 95% rule, an unlimited number of properties of unlimited value, but then the taxpayer must actually acquire 95% of the values of all properties identified. And finally, when we're dealing with identification in a delayed exchange, it's important to address how do you identify property. A few key things to be aware of. Number one, the identification must be in writing. Oral identification does not qualify. Number two, and this one's an important one, it must unambiguously describe the property. So this could be a street address, it could be a legal description, it can be an assessor's parcel number, but it needs to be unambiguous. So let me give you a couple of examples to help illustrate this point. If a taxpayer is going to buy a two-bedroom, two-bath condo in Hawaii, they don't identify any two-bedroom, two-bath condo in a complex. They have to identify a specific unit, Unit 37 or Unit 234, specific properties. So it needs to be unambiguous. When dealing with fractional ownership, where a taxpayer acquires a slice, a piece of a much larger building, the taxpayer is going to want to identify the fractional ownership that they intend to acquire. So they might do that by a percentage, they might do that by showing how much equity they reinvest and how much debt, But if they're going to buy a small slice of a much larger, let's say $50 million commercial building, they don't identify the whole building, they identify just what they intend to acquire. In terms of how to get this to in terms of how to identify, it must be hand delivered, mailed, telecopied, or otherwise sent. The word telecopied, really think of the word fax. The 1031 rules came about back in 1990 were the proposed Treasury regulations, and the final Treasury regulations came about in 1991. So fax was a common method back then of transferring documents, whereas today things like email are much more common in the business place. And along those lines, a practical note, if you want to send identification via email, the best way to do that right now would be to identify on a piece of paper, sign and date that, scan that in as an image. Let's say a PDF image is fairly common, and then send that on over to the entity that you're identifying with. Finally, with identification, the cutoff is midnight of the 45th day, and this needs to be delivered to the qualified intermediary or a party related to the exchange who is not a disqualified person. Most of the time, 99% plus percent of the time, the taxpayer is going to identify with the qualified intermediary. Although the Treasury regulations do provide some examples of parties that are related to the exchange who are not a disqualified person. So if you fall into that scenario, please give Asset Preservation a call to explain that in much more detail or talk with your tax or legal advisor. To review your specific 1031 exchange situation, contact Asset Preservation's headquarters in California at 800-282-1031 or our Eastern Regional Office in New York at 866-394-1031. Please read the full disclaimer, as Asset Preservation cannot provide tax or legal advice.